Hello everyone, this is Damon Scott, and this is the first lecture for Financial Accounting 1 for Chapter 1, which goes over an introduction to accounting and business. There are six learning objectives in this first chapter, okay? And again, this lecture is designed for you to use the slides that are provided in the Chapter 1 folder under the Lessons tab to follow along, almost like a transcript, to follow along with this recording so that you can learn the information or to be used as a foundation to learn the information in Chapter 1. So the first thing that we're going to talk about, our first learning objective, is to describe the nature of a business. Then we'll talk about the role of accounting in business. And then we'll talk about the role of ethics in accounting, okay? Obviously, a business is there to produce a profit. All results of operations is going to be expressed in terms of accounting information. And this is why accounting is known as the language of business, because all results of operations, whether you're profitable or not, is going to be expressed in terms of accounting information. Now, if you do not have ethical accountants, then you're going to have accounting information that's not accurate and that's not fit for business decision-making purposes. And as a result, it's kind of like garbage in, garbage out. You get bad information, you're going to make bad decisions based on them. Okay? And so as a result, we'll talk about, again, the nature of a business, the role of accounting in that business, and then the role of ethics in accounting. We will summarize the development of accounting principles, and then we'll relate them back to practice. Now, understand that generally accepted accounting principles are going to tell us what principles should go through your work or should guide your work, but it's not going to tell you what to do. That's what the consultant or the accountant is there to do, is to decide what to do. But again, this is going to tell you what principles should be a part of your work. For learning objective 3, we're going to state the accounting equation and then define each element in terms of each element in the accounting equation. So that's going to be assets, liabilities, and owner's equity. Those are all three of the assets all three of the elements in the accounting equation. However, your accounting equation is going to be assets equals liabilities plus owner's equity. And we'll talk about that. For learning objective 4, this is where we begin to actually get some work done. We will describe and illustrate how business transactions have an impact on that accounting equation. So we'll talk about how business transactions can be recorded in terms of how they change all of the elements in the accounting equation. Every single time you engage in any different type of transaction, you buy an asset, well, your assets are going to go up. If you sell an asset, your assets are going to go down. If someone pays you for providing services, again, your assets are going to go up because your cash account is going to go up. If you have to pay a bill, then your cash account is going to go down, but also so is your liability account or your expense accounts, which means your owner's equity is going to go down. So every single time there's a different transaction, there's going to be a change in your accounting equation. You're going to hear me refer to the accounting equation as a capital structure. Every single time you go through it, there's going to be a change in your capital structure. And so as a result, we'll talk about how those business transactions impact the accounting equation. Then, for learning objective 5, we're going to talk about how financial statements interrelate. There's a specific order that you have to use in putting together financial statements, right? For instance, you have to put together your income statement first prior to putting together a statement of owner's equity. Once you put together a statement of owner's equity, then you have to put together a balance sheet. Once you put together a balance sheet, then you have enough information to put together a statement of cash flows. Okay, so they all interrelate. Net income or net loss is from the income statement is reported on your statement of owner's equity. The statement of owner's equity is reported on the balance sheet, and then cash from the balance sheet is reported on your statement of cash flows. Our final learning objective 6, is going to describe and illustrate the ratio of liabilities to owner's equity in evaluating the condition of a company. For instance, Lehman Brothers was one of the founders of Wall Street. And so as a consequence, Lehman Brothers, this was a very wealthy company. But when the housing crisis hit, and it turned out that they had millions and billions of dollars in toxic debt, they ended up going bankruptcy, or they ended up filing for bankruptcy. Why? Well, the company had a debt-to-equity ratio of 44-1. And what that means is that for every $1 of owner's investment in the business, or for every $1 of owner's equity, they had borrowed another $44. And so the people who really lost in this case were the other banks that had actually loaned them money. Okay? So, we'll talk about that as well, the debt-to-equity ratio. Now, what you should be thinking about as it relates to the debt-to-equity ratio is how then should I look at if a company has a high debt-to-equity ratio or a low debt-to-equity ratio? What you should be thinking about is if you're a lender and a bank and a company has a 44-1 debt-to-equity ratio, would you be interested in loaning them any more money? Well, what if their debt-to-equity ratio was 0.15, which would mean for every $1 of invested in capital in the business, they only have 15 cents of liabilities? How would you feel about loaning that company some money? Okay, so again, we'll talk about learning objective 6. But for right now, we're going to turn our attention to learning objective 1, just to describe the nature of a business and the role of accounting in the business. Okay, so go to the next slide. A business is an organization in which basic inputs, basic resources, such as materials, such as labor, all of those things are assembled and then they're processed to provide goods and services to customers. The objective of most businesses, next slide, the objective of most businesses is to earn a profit. Profit, obviously, is the difference between the amount received from customers for the goods and services that you just provided and the amount that you paid for those inputs to actually provide that good or service. There are 3 different business models that you can do business as. You can do business as a service business, you can do business as a merchandising business, or you can engage in commerce as a manufacturing business. Okay? From an accounting perspective, your responsibilities are going to change depending on which you choose. For instance, service businesses don't have inventory accounts, but merchandising businesses do. Merchandising businesses have one inventory account, whereas manufacturing companies have 3 inventory accounts. Okay? Your service business, you don't have inventory in that business because you don't sell things for a living. Service businesses, they provide service for a living, and so as a result, you get paid what is known as a fee to provide that service. If a barber cuts your hair and you pay them $30 for cutting your hair, you just paid the barber a fee for cutting your hair. If a dentist pulls your wisdom teeth, you pay the dentist $1,200 for pulling your wisdom teeth, you just paid the dentist a fee for providing that service. Whereas if you go from the service business down to the merchandising business, now they are involved in the process of selling general merchandise. If you take a look at Amazon, they started out selling books, then became music, movies, now it's just about any and everything. Okay? And so again, they make money selling things. They don't make money providing services to people. So as a result, merchandisers don't have what is known as fee revenue on their income statement. They may, because it may be a very small part of what they do, But for the most part, merchandisers have one inventory account. They have to buy things at a low price, mark them up, and resell them. And so as a result, now their top line revenue is not called fee revenue, because again, they don't provide a service to people. Their top line revenue number is called sales revenue, because they actually make money selling things. Now, if you take a look at the manufacturing business, you go from having one inventory account called general merchandise to 3 inventory accounts called raw materials, work in process, and finished goods. If you're making ice cream, you have to throw a packaging inventory account in there, and so you end up with 4 inventory accounts. But I digress. Again, your manufacturing company can provide both a service or it can actually sell goods. For instance, if you take a look at the stock symbol FLEX, Flex, there is a company out there called Fitbit. Fitbit produces fitness trackers. However, Fitbit is great at producing the technology for the fitness tracker. However, Fitbit does not manufacture its own product. It outsourced the making of that product to Flex Corporation. And Flex Corporation makes the Fitbit for the Fitbit Corporation, and they charge them a service or charge them a fee for providing that service to them. All other goods they make in-house, they just sell directly to the market. Next slide. Accounting can be defined as an information system that provides reports to users about the economic activities and conditions of a business. It is important for students to remember that accounting is not just about counting numbers. Accounting is about knowing when to count numbers and when not to. Accounting is about knowing a system. And if you understand the system, then everything else will make sense in terms of when to add something, when to subtract something. Next slide. The process by which accounting provides information to users. You start first by identifying the user, know your audience. The second thing you do is assess the user's information needs. Okay, is this a service business? Is it a merchandising business? Is it a manufacturing business? Okay. Then you design the accounting system to meet their needs. You allow them to go ahead and do business so that their business can now record economic data about the business activities and events. And then at the end of that 30-day period, you prepare financial reports for the users to see if those financial statements are useful for their decision-making purposes. Next slide. Actually, I want you to go over to the slide that says, go over to the slide that says managerial accounting. The area of accounting that provides internal users with information is called managerial accounting or management accounting. In management accounting, what we're learning or what we're doing is providing information to help people manage the company better. What should the price of our product be? What should the price of this service be? Okay, how much does it cost us to provide that? Should we make it in-house or should we outsource it? All of these are managerial accounting decisions. Okay, managerial accountants are employed by private businesses in what is known as private accounting. Because again, you're at Coca-Cola, you're at Delta Airlines, all of these companies are going to teach you the way that they like doing them. They like doing accounting, so it'll teach you everything that you need to know. Next slide. The area of accounting that provides external users with information is called the financial accounting. Okay? When we talk about external users, we're talking about 3 different types of people. We're talking about regulators, creditors, and investors. Okay? Regulators decide whether or not you can sell interest in your company to the public at large. Investors are deciding whether or not they want to give you some of their money so you can actually make that money grow. And your lenders are just deciding whether or not to loan you money to help you run your business. Okay? So again, financial accounting is the area of accounting that provides external users with information. The objective of financial accounting is to provide relevant, timely information for decision-making needs, of the users who are outside of the business. Again, investors, creditors, and regulators. General purpose financial statements are one type of financial accounting report that is distributed to the external users. Again, all of those financial statements, the balance sheet, the income statement, statement of cash flows, all those will be forwarded over to the users, be it creditor, investor, or regulator. The objective of accounting is to provide relevant, timely information for user decision making. Accountants must behave in an ethical manner so that the information that they provide will be trustworthy and thus useful for decision making. Ethics are our moral principle that guide the conduct of individuals. Okay? So I want you to take a look at this next slide where we talk about Exhibit 2. And on Exhibit 2, you can see what happens when people do not behave ethically. Okay? For instance, AIG used sham or fraudulent accounting transactions to inflate their performance. The CEO resigned, the executives are criminally convicted, and the company ended up having to pay about $126 million in fine. And you can see time and time after again, fraudulently inflated results, improperly shifted financial performance. And every time you do, you go over to that last column where it says results, and you can see executives indicted, okay, companies fined, so on and so forth. Enron was probably one of the worst companies, one of the worst cases of fraud because it just went on for years and years and years. So I want you to continue back to the question, to the page where it says the role of ethics in accounting and business. And it asks the question, what went wrong at these companies? Okay? And we see that there was some type of failure of not only individual character, but there's also this firm culture of greed and indifference to ethical conduct and behavior. Dr. Cornel West is famous for saying that indifference is the one trait that makes the very angels weep. George Bernard Shaw said that indifference is the essence of any humanity. Okay? And so it's really important for our students to realize that in accounting, what you do has an impact on other people. And I tell you that in all things in life, you're going to have to reap what you sow. It doesn't get any more plain than that. All right? If you do things and you end up hurting people with your profession and your accounting, eventually that's going to come back on you. Okay? So you want to be ethical. All right? You want to be absolutely ethical and above board no matter what happens. Go to the next couple of slides where it says opportunities for accountants. Accountants and their staff who provide services on a fee basis are said to be employed in public accounting. Accountants employed by a business firm or a not-for-profit organization, they're employed in private accounting, like working for Coca-Cola or Delta. Public accountants who have met the state's education requirements, which in the state of Georgia, that's just having a bachelor's degree. You've met the experience requirement, which means you've worked under a CPA for 2,000 hours, which is 1 year, and they've passed all 4 parts of the examination. They may become what is known as a certified public accountant. Okay? If you go to the slide, next slide, where it talks about accounting career paths and salaries, I would take a look at the difference between the information technology auditor versus the rest. Accountants, understand that accountants are generally well paid, but the ones that have an IT background are usually the ones that are paid the highest. For local firms, those numbers are closer to being about $50,000, and for the national firms, those numbers are closer to being about $65,000. So now is a great time to pause, and we're going to allow you to pause just for a moment so that now you can take a break before we begin learning objective 2. So